morning to you, wherever you're listening from, Nigeria, the UK, wherever you are, welcome. This is the Morning Spaces with Kalu Aja, that's my name. Today we're going to talk about the Nigerian economy, right? What should we expect the second half of 2022? Of course, we're going to review the first half of 2022. We have a top team here today. We have some folks from Cardinal Stone. They're a stockbroking asset management firm, of course, licensed by the Securities and Exchange Commission in Nigeria. So they're going to just walk us through the data. They have a great report out, right? So we're going to look at their report. We're going to ask them a few questions, and they're just going to dive really deep and just talk to us as investors. There's lots of stuff going on in the world. We should then try to get them answer those questions to help us, be better investors per se, right? So I'm going to ask them if they're going to share the report, but I have a copy of that report. It's fantastic. It's very, very detailed. They've been able to, should we say, drill down and add a lot of questions, a lot of data to it, and also very, very actionable, very, very actionable. So I love it. I'm just going to add this, guys. So I've got the Cardinal Stone guys. Just request to speak. I'm just going to argue real quick on it as a speaker. But let me just give you my own view of 2022. This is a year of lots of uncertainty, right? A year of lots of uncertainty. No one saw the war in Ukraine coming. We just came out of COVID, right? Lots of government spending, lots of inflation headwinds, right? And then suddenly we have this Ukraine-Russia issue. And what that does is it makes commodity prices very, very high. And commodities are what you buy to process to then sell, more or less, right? So you're buying wheat to make into bread and to biscuits. You're buying crude oil to power your factories. And once commodities, crude oil, wheat, gold start to go very, 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 very high, right? Then what then happens is that you then have a situation where costs rise above profits. And any businessman knows that when your costs are higher than your profits, what you do, you shut down. So you don't have unemployment going on, right? That's what you see happening in the world. High inflation. And what is inflation? It's very difficult to explain inflation, but I'd like to explain inflation in terms of what you see. So what you then have is that a depreciation in your purchasing power. You have a depreciation in your purchasing power. That's really what inflation is, and that's what you see happening globally. So everywhere in the world, the US, the UK, Nigeria, Asia, everyone is experiencing depreciation in their purchasing power. That's what's happening. And then you then add into the uncertainty, right, of higher prices, and we don't even know what's going to happen in the world. Where will oil prices go to? Will there be unemployment? If there's high unemployment and there's high inflation, then you have this new word called stagflation, which then occurs, right? And when that happens, what does the Federal Reserve do? They're going to sort of raise rates to kill off inflation, but in doing that, they also kill off the economy. So you have lots of stuff going on that's going to basically pull the economy one part and the other part. Hence, we want to essentially understand what's going on. Hey, Philip, you need to request to speak. The Cardinal Stone guys request to speak, so I can add you. I don't see a request to speak. Request to speak, I'm just going to add you.
I think I just did.
You're on. Hey, Peter, how you doing? So I'm very, very well. Thank you for joining us, right? So yeah, once they request, I can add them. How's your day going, Peter? You want to introduce yourself to our guest today?
My day is going fine. I'm Peter Morgan. I work for Cardinal Stone Partners as the head of proprietary trading.
Okay.
And we're here.
What does proprietary trading mean?
Also, joining me. But I guess they might be having network issues or something.
Yeah,
I'm sure they'll join soon.
Yeah, once they request, I'll add them, and then we can get to it.
Cool.
Yeah. So Peter, I asked a question. What does proprietary trading mean?
Okay, proprietary trading means trading the firm's capital. trading the firm's capital. Yeah, so there's client trading, there's proprietary trading. So directly trading.
I think I lost you. All right, guys, so I'm just going to take it over from here. Oh, let me just see. Mo is right here. I'm going to add Mo. There we go. So if you can log, just go out of the space and come right back in. Twitter is very, very finicky. Sometimes you've got to go out of the space, then come right back in, and then you'll be able to speak, Peter. Hey, Peter, you're back. You were telling us about proprietary trading.
Yeah, proprietary trading simply means trading the firm's money in the capital market, trying to make money for the firm, basically, using the firm's capital. Yeah.
So you're a guy that makes money, more or less.
Try to.
That's what we want to hear. That's what we want to hear, right? So, Peter, if you can, right, I have the report in front of me. So, first of all, I want to say a big congratulations and a big thank you to the guys at Cardinal Stone for preparing that report. I found it very, very detailed. It talked about everything from politics to the global economy to the Nigerian economy. And then I found the actionable part of the report very, very refreshing. They were telling me this is what's going to happen in Nigeria with palm oil. So invest in this particular stock. This is what's going to happen in banking because of this indices. So invest in this particular banking stock. I like it, right? So first question, is it going to be available to everyone to read? That's the first question. Can everyone get this report? Peter? Peter, I think I lost you again. Okay, guys, I mean, I have the report. If Cardinal Stone wants, I can share it so you guys can actually follow.
What we see now in terms of global markets, in terms of what we see in monetary policy and where we think investors should position going into the election year. You talk about palm oil stocks. I mean, we've seen a trend. At the start of the year, we saw what happened with Russia-Ukraine war, and that spurred the rise in global commodity prices. So we saw the likes of Indonesia also ban.
Peter, I think you're going off and on. So yeah, Peter, you need to maybe change where you're sitting. Your network is going off and on. Hey, Jerry, can you hear me from Cardinal Stone as well? How are you doing today?
Hi, Gary, I can hear you.
Excellent. Peter's network is off and on, so he cuts in and out. But let me just, maybe don't introduce yourself to the house so we can get kicking. Go ahead, sir.
Oh, great. Okay, so I'm Jerry and with Cardinal Stone as well. I work in the research unit of Cardinal Stone and we're just part of a team that produced this report that we're about to discuss today. Basically cover banks and financial services and also support other sectors of coverage that we have within the company.
Well, first of all, the report is excellent, and I was trying to get from Peter, right? Is this report going to be available to everyone? Can I share it, or is it only for your clients?
No, absolutely, it's available. I think we also have it on some of our social media sites, so it's available. You can share it. That's the reason why we produce it in the first place.
Excellent. So, guys, I'm going to share the report so you can sort of follow and just see what we're talking about in terms of the report. I think it's excellent. I like the ending part. But Peter, Jerry, can you just walk us through the report? What were you guys trying to elicit? What was the end goal of this report? Like, I like it, like I keep on saying. I like the fact that you're making recommendations. So if I'm not an investor guy, right, I can go to recommendations and I see where you guys are coming from in terms of the sectors and the particular stocks. But what were you guys thinking about when you did this report?
Thanks for that question. So I think basically we try to give a snapshot of what to expect as we approach the second half of the year. Of course, we're already in it. In investing, when people invest, a whole lot is being considered or needs to be considered when it comes to investing. You have to consider the macro environment and the climate you want to invest in, consider the political environment, consider the prevailing themes across the globe, because globalization implies that whatever it is that's happening in some quarters of the world has also impact in your own locality. So we try to consider all this in producing this report. We spoke about global development, global political tensions, what's going on with inflation across the globe, global equities, and then talk about inflation as well, and the impact of policy responses to deal with some of these concerns we're seeing on the global front. And we also try to narrow it home, talking about growth expectations domestically. We try to speak a bit to electioneering, because that's going to be a key conversation, a key discussion point in the second half of the year with material implications for investment. So we spoke about politics, talked about domestic growth, and the key issues that the everyday Nigerian is facing: inflation, higher prices, what's going on with currency, what's happening in the equities market and the fixed income space, how can I invest? We try as much as possible to answer the key topical questions or issues that every investor would want to see addressed.
I like it a lot. Let me walk you through the report, right? Just if I could ask you a few questions. I see we start off by talking about capital flight for emerging economies. So money is leaving, say, Nigeria, Africa. How big is that a problem for Africa? I mean, if money is leaving, what's the problem?
Well, that's interesting. It's a reflection of what we're seeing happening across the globe, right? So money leaving means that the money was initially in the first place. Mm-hmm. Across the globe, you have investors who are chasing higher returns, and the thing with countries like Nigeria or African countries or emerging market countries is that they tend to offer investment higher yields compared to what you have in developed markets. Maybe look at the fixed income space in Nigeria, for example, in Africa compared to what you have in the US. So we have investors who tend to chase these higher returns, of course, into consideration the risk in these markets. But what we're seeing in the global space, high inflation ordinarily suggests that, and like we've already seen, the Fed is hiking rates in the US, the Eurozone is doing the same thing, the UK is doing the same thing, Japan may likely follow suit, even though they're trying to show it up at the moment, right? So these guys are also raising rates, shrinking the spread, the premium that traditionally investors have enjoyed, by investing in emerging markets or countries like Nigeria versus investing in the US. So it's basically shrinking the premium, and that's partly why you're seeing the capital flights, basically just trying to avoid the risk in these markets. What we are seeing, so this capital flight is also an issue of contagion, right? So if there is worry about what's likely to happen in country A in Africa, investors are typically worried that may spill over into country B and country C, so everybody just follows the bandwagon, and that's what we're seeing. I can say that in the first half of the year, we've seen over $18.7 billion leave emerging markets.
Wow, that's a lot. 18.7 leaving. And let me just make sure I understand what you're saying. So you're saying that in Nigeria, for instance, our Euro bond used to be about, say, 8%, right? And before we had all these issues, the American bonds were paying, say, 1 or 2%. But what you're saying is that because the US bonds are increasing their rates, it's now reducing that risk premium that Nigeria is paying. So if US increases rates to, say, 4%, right, and Nigeria is 8%, a US investor could say, well, 4% is not enough compensation for me to put my money in Nigeria. Is that what's going on?
Yeah, absolutely. That's my consideration.
Okay, so how has this global theme of money leaving emerging markets, high inflation, uncertainty, how has it shaped the policies and market performances, say, globally and of course in Nigeria?
That's interesting, right? So policies, what we've seen globally in terms of policies, and let me just begin. It didn't necessarily come as a surprise, because since COVID and as countries across the globe try to recover from COVID, there's been talk about the worry that inflation was portending from most markets, and the Fed, for example, the US have talked about raising rates since last year. Right, they've only tried to be cautious, they've tried to be hesitant and careful because they did not want to spook or disrupt the recovery happening in the US post-COVID. With the war in Ukraine and then the associated sanctions, the spillover effects coming from supply chain disruptions. This led to high energy costs, high energy costs, high food prices. And this meant that these developed countries like the US, had to accelerate the pace of tightening, and that's what's happening. Right? Inflation in the US is about, it's at a 40-year high.
Yeah.
About 9% the last time it came out. This is for a country that has an inflation target of 2%.
2%.
How wide that is.
Yeah, so we're saying target is 2%. US inflation right now is 8%. That is just, quote unquote, messing up a lot of stuff.
Yeah. So basically accelerating the pace of monetary policy responses, we like to see in this country.
So that's what's basic. So the Fed is now, in response to this inflation, is going to raise the rates. And we all know what that means. Let me put it in a certain way. The way you kill inflation is to kill inflation. So you kill the economy, so inflation goes down. That's what the Fed wants to do with the 8%, right? So is this going to be a major pass-through impact in terms of the global stock market recovery and all that? If the Fed kills the markets, what does it really mean? Philip, thanks for joining us. You want to take that? Jerry, I think Philip is not in here. So Jerry, do you want to attempt that? I'm worried about what will happen if the Fed raises rates to an astronomical level. What happens in the US? What happens in Nigeria? Do you have an insight to that? Maybe you just give us your take on that.
Well, it's firstly, there are really concerns about implications on growth. Right, there are really concerns about implications on growth. That's one conversation that's going on right now. There are talks about the US and most global economies going into a recession next year, because the more you hike rates, the more you make it difficult for people to borrow to invest, and if people cannot invest, you hardly see any expansion.
That's true.
So there are reports about it, in addition to the pass-through effects of the war. So I think that's one major consideration when it comes to having to raise rates. But inflation is a big problem, and from the hints that we've been getting, they seem resolved to want to deal with it.
That's it. Philip, you want to add to that? Yeah.
Yeah, thank you very much, Kalu. I think Jerry has very much addressed some of the issues on inflation and consequent tightening in rates. But I think it's important to note the second order effects on countries across the globe, right? When you are a net commodity importer, then you begin to feel a greater crunch.
Yeah.
Inflation in those countries are more or less rooftops. According to the IMF, I think 40% of total consumption across most sub-Saharan Africa is food related, and it tells you everything you need to know about
what does that mean?
It means that 40% of our total consumption in sub-Saharan Africa is on food or food-related products, basically.
Gotcha.
And what's fact is that most times these food products are imported. So as you're importing it, you're importing all the inflationary pressure. So sometimes it's only called imported inflation. Okay. You import it from troubled places, and it comes down into those countries to more or less distort the macros, right? And I think it's also important to note the impact of the policy responses to this inflation, the continued increases in rates, how it's affecting the cost of borrowings, right, for countries across the globe. So borrowings become increasingly difficult for a number of sub-Saharan African countries that are already close to distress position. They already have a huge backlog of debt, right? And because the savings culture in those kind of economies are not so developed, and the capital market are not so robust, they still rely on borrowing abroad, right? Yeah. So as interest rates increases in the fight against inflation, that will cascade to expensive costs or higher costs of borrowing for most of these markets. So it has far-reaching implications across the globe, and particularly for sub-Saharan African countries like Nigeria.
I hear you, Philip. And also, I did read a report that Egypt, for instance, gets almost 80% of its grain from Russia and Ukraine. So for a country like Egypt that cannot even get the grain, even if they had the money to pay for the grain. So food costs go up in Egypt, inflation goes up in Egypt, they would then make their ability to repay their debt go up as well, kills out the economy for an issue they have absolutely no control over. This is the point you're making, right?
Absolutely.
All right.
It's the point you're making. And it reinforces a whole lot of other problems. You have issues of that have to do with cost of living.
Yeah.
You look at the misery index and
what's the misery index? What's the misery
index? More or less captures the level of unemployment and inflation. Some sort of sums it up, right? These are indicators that actually measures the social and economic costs of difficult macro on the populace of the country.
So high inflation, high unemployment means you have a high misery index. So I won't ask you Nigeria's misery index for now. But let's just move on. So guys, let's get now into the domestic economy. Let's talk about Nigeria in particular, right? So Philip, Jerry, Peter, how would you guys assess the growth of the economy? So in terms of just the growth, GDP growth, are we back to where we were before COVID hit? Let's have
if you talk in terms of the growth, we think that really in terms of the growth rates, we are doing better than what we had in 2019 because I think we've seen growth rates of about 3%. Expectation is that we'll grow at 3% this year. That is for growth. But then growth does not paint the entire picture. There's something called per capita income, right? On the per capita income front, we are still lagging most sub-Saharan African peers, and it's very important to point that out, right?
Yeah.
And you also want to look also at the distribution of growth or the quality of growth. When you talk in terms of the quality of growth, it more or less speaks to the sustainability of growth, right? So what is the income distribution in the country? What is the per capita income? What is the level of education? How much do we spend on health, right? So so if you look at all these issues, you still see that there's still sizable gaps to be filled, right? Because those factors will influence other things like cost of living, security. And security is very important because if security worsens, it affects production, and production will also cascade to weaker growth in future. So it's important to look at it from those dimensions, right? The quality of growth. Is the Nigerian growth being propelled by labor-absorbing sectors? Or is it just driven by sectors that are not really labor-intensive, sectors that cannot really absorb
Philip,
labor?
I want to pause you there just so that I can track and just explain what you're saying now. So I have the snip from your report. I'm just sharing it on Twitter right now. So guys, if you go on the Twitter line, you see what Philip's talking about in terms of GDP per capita. So Nigeria's GDP per capita is right now about $2,085. So Angola is doing better than us, Ghana is doing better than us, Egypt is doing better than us, South Africa doing almost 3 times better than Nigeria. So Philip is saying, yes, we are seeing the 3.1% growth, but when you break that growth down into the individuals, the moms and pops, Philip, Peter, myself, you all on Twitter, that figure falls to about 2,085 per person, which is not that fantastic. And of course, Peter, I'm making the point again that where even is that growth coming from? What sector is that growth coming from? Is it coming from agriculture that employs a lot of people, or is it coming from, say, oil and gas? So just want to put that up, Peter, and it's right there on the chat in case you guys want to follow. Go ahead. So go ahead, Peter.
Yeah, so these are pertinent issues on growth. I think they are very important to point out. But I just want to home in on the issue of security.
Gotcha.
That doesn't just impact growth, but it also impacts what we call inflation or cost of living, because it's a very critical driver of inflation. And of course, inflation has impact on growth because if you are growing in nominal terms by 10% and inflation is at rooftops, right? Sort of actually wipe out the benefits of growth in real terms, right? So you may be saying in nominal terms, growth may appear good, but if inflation is rooftops, essentially people are becoming increasingly poorer. So those factors are important. So security is very critical in terms of how it impacts the overall economy, growth, inflation, etc. So I just wanted to highlight that.
Yeah, and Philip, let me just get back to Philip again, Philip and Jerry. The current drivers, are they sustainable? What's the answer to that? I mean, is Nigeria on a sustainable path with the GDP drivers that we have, which are basically agriculture, services? Is that the right thing to do? Are we on the right, I mean, yes or no, more or less?
Yeah, we think that GDP in excess of 3% is not sustainable at the moment, and we'll explain why. The first reason is that the GDP growth in excess of 3%, we've been saying, I think since last year, as a result of materially low base effects, right? Materially low base effects since the COVID. So there's this continued recovery we've been seeing. There are some sectors that in absolute terms are not back to where they were in 2019, 2018, etc.
Yeah.
Right? So that's one. And two, sustainable growth is a growth that is all-inclusive. All-inclusive in the sense that it's a growth that more or less accounts for sectors that accommodate a whole lot of people in terms of employment generation.
Yeah.
Right? So if your growth is being propelled by circa 5 to 10% of your population, right, while the other 90% is contributing next to nothing, right? Such growth is not inclusive, and ultimately it will breed things like greater inequality, insecurity that will come back to bite the economy, right? And when it bites the economy, it now becomes even harder to sustain the growth levels that you are seeing now. So we think for these reasons, and possibly the slow pace of policy implementation and execution, we think that this growth will not be sustainable unless certain or these factors are looked into and addressed going forward. So we think that we may just lapse to the 2% within 2 to 3% levels.
And Philip, just to be clear, right? Nigeria's population growth is about 3%. The GDP is growing at about 3%. So there's no quote unquote real growth there. The population and the GDP are almost going at the same pace. I see your figure 16 on the report, right? Our growth is coming from services, from manufacturing, and from agriculture. I would argue that services, agriculture employ the largest amount of Nigerians. I mean, currently. Is there another sector that is employing a lot? Maybe I would say telecoms, that is not growing, that you would want to see Nigeria focus on job creation in that particular sector?
Well, I think services, you hit the nail on the head. It's one sector that is evolving and continues to absorb a lot of people. Agri, we think that agri should be growing faster than what we are seeing now in the agri space.
Agri here is just 2.1%. Very, very anemic. Just to buttress your point, Philip, 2.1% growth in agriculture is very, very anemic for a country with a land and population like Nigeria, Philip. Yeah, but go ahead.
Exactly. So, and to point out, you must realize that there was a heavy slump in terms of the level of economic activity that happened in 2020. So, progressively, we are coming out of that slump, but there are still some sectors that are still not entirely out. Right? So, when you are coming from a dip, right, every sector looks almost good in terms of the growth perspective because you are coming from a dip. But if you compare where we are at the moment to 2019 levels, you see, maybe this growth is not as great as it's more or less suggests. It's just because there was a huge dip and we are just beginning to normalize across different sectors. So it's one factor. So once that dip is filled, what you'll find is that except there are extra push or extra factors, new variables to actually drive us sustainably higher. Right, you may find that the growth level we are seeing, that is a function of the recovery from the dip, may not be sustainable going forward, except there are new policies in place, except that the security situations are addressed, except, greater funding are sourced and properly deployed, we may not be able to maintain this in excess of 3% growth levels.
Gotcha.
Right? Remember that after the 2016 recession, we're just barely doing 2%, second 1%, 2%. Then the 3% that we're not seeing came immediately after the 2020 dip. So it is very easy to confuse it for sustainable growth if you forget where we're coming from.
I hear you.
But also bear in mind that there was a dip. Whenever you're coming from the dip, it does more or less look like you're getting that example. But in actual fact, right, in value terms, right, the growth may not be that great relative to what you were doing before the dip.
And that's what you refer to. That's what you refer to as the base effect, because the base is lower. If you grow from that low base, it looks like quote unquote growth, but it's not really growth, more or less.
Absolutely.
Okay, let me get Jerry in here. Jerry, the price of things in Nigeria is just going through the roof. Let's just focus on diesel. That's what companies use to manufacture products to sell. So if diesel cost goes up, that just means that the cost of goods in Nigeria is going to go up. With that in mind, Philip, Jerry, what's your outlook for inflation going forward? I'm going to also share how you guys project inflation will be in Nigeria. You guys are saying inflation is going to taper pretty soon by the end of the year. Is that correct? Or what's your outlook for inflation?
Thanks, Carlo. So what we said was that inflation gets to about 20%, by the end of the year. So the tip you see in December, it's still a reflection of the intense pricing pressure we expect to happen. Because even before you get to the 20% in December, we'll see about 21%, sometime in November, right? So these are our reflection of what we expect to happen to price. And I already mentioned diesel. So we classify it, under the energy price pressure points, for inflation. And I think Philip mentioned it, but across the globe, in emerging markets, we're seeing pressures from food pricing, pressures from energy prices, and this is driven down into inflation across the globe. Specifically in Nigeria, you add to food and energy costs, add amount of currency devaluation. That's also the major worry. That's also sustainable worry for inflation. And speaking to the energy, if not for subsidy payments, if not for the subsidy payments that government is doing, probably would have seen inflation worse than it is. The government is actually
oh my God.
a heavy burden when it comes to subsidy payments. So you have very high diesel costs, add to that very high PMS prices. And I think we cannot visualize what the potential impact.
Jerry, let me ask this question again, right? An SME guy, let's say I'm a small manufacturer. I make pure water. My pure water business has one major input, the polyethylene, right? And diesel. So I buy polyethylene, I put the water in it, I seal it. I have to put the generator on for say 3 or 4 hours. You are telling me that I'm going to pay 20%. That my cost is going to go up by 20% in say July, August, September, October, to get to almost 21% in November. Isn't it easier for me to just take my money and go put in the bank and earn 10% in the bond? Can any business survive with 20% inflation?
Okay, so let me clarify that, right? So the 20% that we have for the end of the year is just, if that percentage is a reflection of general price increase, across, different products, different services. So there could be some products where prices this year versus last year will be higher as 50%. You can look at diesel prices now compared to what it was last year.
Yeah.
Right? There are different services. So there are some maybe that have 60%, 70%, 10%, depending on. So what that captures is the baskets of goods that are being monitored, by the National Bureau of Statistics.
That's true, but inflation right now is 17%, and diesel is also being monitored, right, on the CPI basket. So the point I'm making is that if we're still going to have prices going up, does it make sense for any entrepreneur to actually invest in a situation where the country is posting double-digit but sustained inflation?
I think I would like to chime in here. Jerry, if you don't mind, I'd like to chime in here. So, Carlo, I'd like to start by noting that different institutions, different individuals have different inflation realities. If you are playing in the education space, you are a lot more interested in education inflation. If you are in healthcare, you are more interested in healthcare inflation. If you are in my house, you are more interested in the inflation that affects the basket of goods that my wife buys every month. And she calculates it very well to tell you. So the point is, now for different businesses, they will have to track and monitor the inflation that most affects them. The education businesses, etc. But I also want to point out that a few businesses, and they're not, they're quite a handful, have been able to post decent earnings growth. The point is, you should be able to generate enough earnings growth that will compensate for the inflationary pressure. And some businesses have been able to demonstrate that. We can mention a number of them, right, that have posted in excess of 30, 40, 50% earnings growth this year. And their ability to post that is a consequence of, one, the impact or the pass-through from global geopolitical tensions or geopolitical activities on their performances, like the commodity producers. You go check, for instance, the results of Presco, Okomu, Seplat, commodity producers, they are posting. So you talk to them about inflation, they smile at you and say, "We are."
I hear you. No, Philip, I hear where you're coming from. I'm just trying to make the point that it's a big headwind for any small to medium scale Nigerian local manufacturer. What this tells me is that it's cheaper to simply import that inflation from the US, the 8% inflation. So I can import Uncle Ben's rice than attempt to make my own rice in Nigeria, because the cost of running my diesel to process my paddy rice from Taraba might be too much. I'm just making that point out there in terms of inflation, right? I hear what both you and Jerry are saying, but it's double digit. It's been sustained from 2021 to 2022 at double digit. That's quite a lot, yeah.
Yeah, it's quite a lot. Okay, so coming down to the small micro businesses, of course, it's a burden, particularly because their economies of scale is not so great related to the big businesses I was mentioning. So it's a burden, right? But I think it's still going to vary even within that space, depending on factors like maybe the demand elasticity for the products they produce.
Correct.
Right?
Yeah.
Those who are better able to transfer the cost burden, of course, they will still be relatively comfortable compared to the others. But then, I agree, inflation is a burden, particularly to smaller producers.
Okay, let me ask you.
Because of their scale.
Okay, Philip, since I have you here, let me ask you about government borrowings. So now the government, we're talking about the deficit, the debt, and of course the deficit financing for the budget. I'm going to also post from your report the figure 23, the accelerating debt service to revenues. It's crazy. You guys actually have a title on your report saying revenue pays debt, not GDP. I've said that over and over and over. We quote debt to GDP. It doesn't mean anything. It means nothing. Revenues pay. And from your chart, the debt service to revenues, believe it or not, guys, it's approaching 100%. Debt service to revenues is approaching 100%. Philip, what's your take on this? I mean, how do you assess government's continued heavy reliance on borrowings? Is there an alternative to borrowing?
Well, to start, I would want to say that the government's high borrowings is a consequence of the need to balance its budget, given revenue shortfall, and also given the net impact of high subsidy payments, which more or less leads little or nothing for capex implementation. Between January and May, right, I think gross oil revenue was close to about 1.9 trillion. But I tell you that we spent close to 1.3 trillion, almost about 70% of it, paying subsidies. By the time you remove JV costs, joint venture costs, that's another 500 billion. Leaves little or nothing. In fact, there was no remittance to the federal government between January and June from oil revenue. We don't see everything in January.
Unbelievable.
There has to be capex. There's huge infrastructure gap. There's a need to fix roads. There's a need to invest in the railways to support the transportation of things like maybe food from surplus deficit. So you have to invest in capex. So that tells you what you need to know on the issue of debt. I think in terms of trying to get alternatives to borrowing, we think that is going to be a more medium to long-term solution, because you have to build your capacity to raise funds from relatively stable sources, not just oil. Oil is so volatile, right? So why not try to diversify and boost non-oil export proceeds?
Okay. I mean, your answer is, Philip. Your answer is correct. You are right. We when we earn money from crude oil, the money goes towards debt service and maybe salaries, and we have nothing else. So we have to borrow to build the roads. Correct answer. I'm just stating that really, when you just say it casually, that the debt to revenues is almost 100%. It's jarring. It's really jarring. I mean, in terms of just nominal figures, Japan and the US are borrowing in excess of their GDP, but their capacity to pay is okay. But in our own instance, we are borrowing nearly in excess of our revenues. That's a huge red flag to me. But let me jump to Jerry. Jerry, why are we borrowing if crude oil is at an all-time high, or has been at an all-time high since 2021? Crude oil was almost more than $100 a barrel. Why is Nigeria still borrowing money if we have crude oil retailing at more than $100 a barrel for nearly 24 months? Jerry, can you jump in here?
Yeah, thanks, Carl. So there are two sides to it, right? To revenues that come from oil. On the one hand, you have oil prices, which of course has been very, very good super this year. On the other hand, you have oil production. So the total receipts you're likely to get is a function of the interplay of those two variables. And while oil prices have been doing very well, sadly, oil production has not been very good for us. It's not been very good. I mean, there the incidents days in vandalism, theft, constant maintenance of the pipelines. So these have not really done well for us. To be able to make the most of the oil windfall, the oil price windfall that we've seen this. So that's the main concern. However, that said, despite this, oil revenues, I think Philip was questioning, oil revenues this year for Nigeria is as high as about 33%, 32% thereabout, higher than what we did last year. But he also made an important point of the impact of subsidy payments. So when I get about 1.9 trillion in oil revenues, that's at moving, and I have to use 70% of that to take care of PMS subsidies, there's almost nothing left. Right, so you have about 600 left thereabouts, and then from there, JVs and then pipeline maintenance and everything. And like Philip mentioned, between January and May, nothing was remitted to the federation accounts.
Jesus.
This year, the back disbursement, which is what the federal government disburses to states, has been in a decline because of this factor. So that's the main concern. What are the alternative sources? Raise taxes. Maybe the government should raise taxes, but of course, you cannot tax people who are unemployed. You talk about the impact of growth, right? Growth needs to be sustainable, which means it needs to be inclusive. When you have high unemployment of 33%, who don't have jobs, there is no economic activity or very little economic activity that can be taxed. The taxes in Nigeria is one of the lowest in the world, really compared to the rich and prosperity. Even though in recent years we've been able to do well in terms of collection of taxes, right, higher every year, but it's still not enough. It's still not enough. So whatever it is we're getting from taxation, those oil receipts are not enough to actually fund the economy. So the government has to resort to oil.
All right, guys, and just in case you're listening, right, everything that the gentleman from Cardinal Stone are saying, I'm just also sharing on the tweet. So if you go to the tweet, you will see the GDP projections per capita. You will see the subsidy payments that Jerry's referring to. Jerry, that's a great graph, by the way, you guys did. So you guys broke down the gross oil revenues that we got, right? About 1.8 trillion. You broke it all down. And subsidy alone is taking about 1.2 trillion out of that 1.8. And JB costs come in, then the government projects, pipeline repairs. We've not even talked about salaries. So the crude, we're not even gone, the crude oil doesn't even pay salaries. The crude oil goes 100% to subsidy. It doesn't make any sense to me. We're exporting crude oil and then we're importing. Let's not go there, but it doesn't make sense to me as a Nigerian that we are exporting crude oil, importing PMS, and the entire crude oil revenues has gone. So no remittance to the federal government of Nigeria on that. But the charts are up there, guys, and I see your request to speak. I want to get through the research report to the guys from Cardinal Stone. Then, of course, we'll have you guys come and ask questions. So I see your request. If you just hold on, once we get done, I'll open up the floor. They're going to be here. We've got Jerry, Philip, and Peter, and you can ask them your questions directly. Let me just get through the report and share most of this information. So you also have questions that you want to ask them as well. But Jerry, since you're here also, right? So why does the Naira keep depreciating? So if I'm a trader right now, I was at 110, I got to 315, I got to 414. This is official rates, right? But now it's about 600 in the black market. Why does the Naira keep depreciating? What do you think will happen to the Naira? Should I go buy dollars and keep because it will go up? Should I just hold on my heart? Naira will go down again. What should I be doing right now?
All right, so Naira depreciation, I think that has been constant for us, over the years. Every year it's, depreciation. And I think just like every other thing, it's a reflection of, the interplay between demand and supply, especially for FX, right? That's the major concern for us. Lots of demand and not a lot of supply to meet the demand.
Gotcha.
So when the supply is not enough to meet demand, that ordinarily should drive prices higher, and that's what we're seeing, on the FX side. Naira keeps on devaluing. There is, of course, the joker, right? And for me, what the CBN is likely to do, because what they have consistently done is try to intervene, try to support the currency. Because without the constant intervention of the central bank, probably devaluation would have been worse than it is currently, especially for the official rates, right? But the central bank has continued to support over the years, and that's what they're still doing. The question is whether or not they have the capacity to do it for a very, very long time. Look at the reserves of Nigeria, about 38 billion. It's nothing to be compared to the reserve of its peer oil exporting countries. Other oil exporting countries, look at Saudi Arabia, look at Russia and the likes. Look at the reserves. They have reserves that allows them to support the currency. So the currency there has been constant, has been flat for a long time because they have the buffers to be able to do that. But we don't have this kind of buffers. Yeah. And because we have limited capacity to support. Ordinarily, the Naira should depreciate. And I think that's one of the big concerns, really. In terms of what to do, well, it's not very straightforward, and the reason is because we all know the impacts on the black market rates since the CBN stopped supplying to the biggest. Yeah. Now history has shown that we saw this happen before. We saw this play out in 2016, right? We saw it like 2016. They stopped supplying. The premium between the parallel market rates and the official rates widened. And as soon as there is some supply, that premium shrunk. Again, we've seen the same thing play out. By the time they stop supplying to PDCs, the premium widened materially. Yeah. And that's where we're at the moment. So whatever it is that's likely to happen, there's going to be a new administration next year in terms of who's going to be the president and their favored policies when it comes to FX, they gladly say they are pro-market. Would it mean then that we'll probably see more pro-market monetary policies, right, in terms of, maybe supply to PDCs, valuations, and things that are left to be said? Plus, that's the major one. The CBN seems, hell bent on sustaining the price of the currency where it is at the moment. But we think that the pressures are very significant and probably further devaluation for the end of the year.
That's a good way of summarizing it. You're saying the CBN has tried, should we say, to defend the naira, and it has not worked. I put up your chart right there. The parallel market is nearly 600. Official is about 414. The CBN was paying 5 naira to Nigerians if they do a remittance. I don't think that has worked. People, they've stopped Aboki FX. So people see that there's premium outside the official markets and are going. So perhaps a bit of a combination of devaluation and, of course, more exports might do the trick. But let me bring you all in, Jerry, Philip, and Peter. I'm going to post, you guys have this very, very nice chart, key issues awaiting next president, where you talk about unemployment, you talk about poverty, debt service, security, infrastructure deficit. When I look at this chart, I'm going to put it up real quick so you guys can follow. I see a lot of spending by the next administration, that whoever becomes the next president has to do a lot of spending. But you guys have already, and of course, agreed that the revenues in Nigeria have already gone. So there's a subsidy which takes away the revenues. But there's this chart that's saying we have really got to spend on humans and infrastructure. Where do you see this going? And I want maybe two of you, or maybe one person can give me an answer. Do you think we're going to take away this subsidy and invest more in the HNI, in the human capital indexes, or will we attempt to do both and achieve none? What do you guys think really would play out? Subsidy goes and we invest more in employment, infrastructure, or subsidy stays because it's politically nice, and then we try to maybe wobble and fumble down the road. What do you guys think?
Yeah, thank you very much. I think that all the major candidates have talked up the likelihood of subsidy removal. The major candidates, think Atiku, Tinubu, and Peter Obi, etc. They talked about moving it. But what we think is, given the social realities and the needs to ensure that there are adequate safety nets, this may be more like a gradual approach. So we sense a situation where there will be some sort of gradual approach, given that this issue is a very politically hot issue. So we think it's likely to be gradual. And we think that the leading candidates have all expressed a desire to increase investments in human capital development. Right? They talked about it, and optimistically, speaking on the optimistic front, we believe that there's a likelihood that there may be some progress on that front. But the reality is that given the debts we are in or the challenges we are facing now, it will take some time before the pass-through effect begins to really trickle down, right? So there's usually that need for the big push, right? And there's likely, given the revenue problems that we are having, there's likely to be the need for continued borrowing, at least in the near term. You need to borrow. So borrowing itself is not bad. It's what you do with borrowings, right? If you are borrowing and investing the proceeds such that you are able to enable, right, material growth in production, material growth in earnings across different sectors, like diversified sources with the debt you are collecting, then you're not going to be afraid of debt service or principal repayments.
I got you. Good point.
Debt is what, so that's the key thing. So what do you do with the debt? So there must be productive investments, not debt weight investment. So we must be doing productive investments going forward. And it's the optimism I think a lot of Nigerians share going into the election periods.
So let me just add to what you have said. It's very important to note that the kind of spending that Nigeria needs is spending that transcends just government spending. Because as a percentage of GDP, government spending it's barely there.
That's a good point.
What we need is a lot of private and foreign investments in the country, right? Private spending, yes, we've seen banks extend credits and it's been good, but most of these credits haven't, they've been to the top guys. They're trying to do a whole lot of SMS service. The CBN is also trying to do a whole lot to support these guys. But we need foreign guys to do direct investment. Foreign direct investment into Nigeria, leave that over the years. Going down into negative, and the next foreign direct investment is now negative. Which means they're taking out more than they're bringing in. For all of this to happen, right, there has to be reforms. So the next president will just come in, beyond just focusing on spending, has to create an enabling environment that will allow for the ease of doing business to be good, to be not solid. Create an enabling environment, deal with issues of security, let investors know that their investments are protected, and then attract those flows to develop the critical sectors of the economy, have a long-term plan. It's not something that will happen in the next 2 years. Give it, have a long-term plan. It's going to gestate, and over time we'll probably see rewards, but that's what Nigeria needs. Patient capital coming in to fix and deal with most of the issues, structural issues that we're dealing with.
That's a good point. Good point.
I'd like to tie this to the currency discourse.
Yeah, sure.
Because Jerry was talking about the capacity of the CBN, the reserve levels. It also ties to it, right? So if you are saying that, if you realize, given the experience from history, that the currency crisis we are facing is primarily a supply crisis, then you would appreciate the need to encourage inflows, right? FDIs, like Jerry mentioned, trade credits from abroad, right? Support non-oil sector to, especially those that have like exportable, that are dealing on exportable products, right? Try to encourage those businesses. Diversify the sources of FX, right? And FX issues will be the part, but it's going to take some time, like Jerry noted, right? Rome was not built in a day, so to say.
I hear you. So I'm going to bring Peter in now to talk more about the Nigerian stock market, the investment side, because that's what he does, right? But Philip, just broadly, right, what's the outlook for the market, the Nigerian investing, the bonds, the equities, properties, commodities? What's the broad outlook for a guy that wants to invest? What should we know before I bring Philip to get into the more granular details?
Yeah, for markets, globally we think that the commodity charge may slightly begin to win, right? Because of recession fears. I think Jerry mentioned that. So it may gradually begin to win. But we think on a year-on-year basis, we think commodities will stay fine, stay higher considerably. Then for equities, domestically, let's focus on domestic. For domestic equities, we think that we are still likely to have some double digits growth by the end of the year. That's what we think. However, we think that the performance of the equities market in the second half may be slightly weaker than that of the first half for several reasons. One is the expectations of more or less impacts of political uncertainty, so people may be a bit more cautious on risky investments. There's also the likely impact of higher rates. It's not usually all rosy for equities, right? Or depending on the equities you play anyway. Right, and of course there will be mixed impacts on company performances, but we think that the second half is unlikely to be as strong, right? But net, we think that the equities market will be above the waters. But for fixed income investment, the same. We think that second half will be tougher. So yields may go up and more or less fix into fixed income investments for the second half, right? But then there's a way to play these situations, like I believe Peter will address some of those strategies.
All right. So Peter, you've been patient with us as we talked about the economy, the macro side, and all that fixed income. Let's come over to your desk now. Invest in the day-to-day investing of Naira and Kobo, right? I have your chart here. Top performing stocks year to date in Nigeria. This is my question. The top guys are Meya, 448, Wema Bank, Academy Press, Guinness, and NACO. what's the correlation with these five guys? I see no correlation with drugs, banking, publishing, alcohol brewing, and servicing and airlines. Why are these stocks the top performers? Maybe let's start from there, more or less.
Okay, so what you find is, as the market moves, what you find is a couple of stocks also move, everything moves together somewhat. So you mentioned Maya. Maya is in the pharmaceutical sector. If you follow the pharmaceutical sector lately, you find that stocks in that space have actually moved aggressively. Look at 50 stock, 200% of their so a lot of stocks in that space are moved. We spoke about Guinness. Guinness has had a very fantastic 9 months. If you look at the results, it's been very fantastic. They come up on the lows of 16, they're actually up 132%. So if you look at that space, that explains why. That I mentioned NACO declared a fantastic dividend, declared bonus issue, and investors like it. They also came up from the lows, their numbers are very good, and that's why it has moved. So the market because of these particular stocks, because these stocks may not be weighted on the index. We have other stocks like Philip mentioned Seplat before, or in the oil and gas space as commodity prices moved up. It also rallied over here, so it's done about 80%, year to date. We also have other weighty stocks like Airtel, which in the telecom space are quite liquid, so smaller than Muslim. So that's also done very well this year. So we have some other weighty stocks on the index that have also moved, aggressively this year.
So Peter, Philip, if I'm an investor, am I looking more like the small caps, i.e. those Kobo stocks, the 1 naira, 5 naira, 10 naira, or am I looking more of the higher guy? How should I look at this? Should I look at the pricing? Should I look at the earnings? This for Nigerian stocks. How should I approach when to buy Nigerian stocks?
Okay, so first of all, I'll just put this out there. If you're investing in stocks, equities are quite risky. You need to speak to an investment advisor to help you model the portfolio. So understanding your risk appetite, understanding your abilities to take risk, because equities are quite risky. Things can happen, you can lose some certain part of your money. That being said, what we advise are companies with solid fundamentals. Companies who have decent performance, historical performances, decent earnings, decent revenue. So companies that have dividend payouts, those are the kind of stocks we recommend. So what you will be looking at after speaking to your investment advisor, you'll be looking at companies that model after your needs. Are you one that's you want income? My advice is to go into financial sectors, go into the banks that have decent dividend yield. If you're after capital appreciation, you don't care about income, you don't care about dividends, we advise you to set up a portfolio. You should be having. So it's not just the blanket prices are going up and jumping. Sometimes it's all speculation. And when you go in, you're going to lose some certain part of your money because you don't know what is driving those names. So it's stock specific, it's individual specific, investor specific. So you speak to someone who knows what they're doing, speak to an investment advisor, and they will advise you on how to model your portfolio.
Okay, so let's get particular, right? So I'm looking at your equity coverage. You have the company stocks. You guys are covering financial services, consumer goods, industrial, agriculture, telecom, utilities. Let's talk about, say, Zenith Bank. No particular order, just an example. So not a recommendation to buy or sell, guys, just an example. So Zenith Bank here, you guys have it at a PE of about 2.7. That's pretty good, which means that I am buying this stock when I pay 30 naira. I am buying it at 2.7 times its earnings. That's not bad. And I'm looking at getting a dividend yield of about 15.2%. That's also not bad. So I am a dividend guy. I like dividends because you can tell me any returns you have, I made profit. If you don't pay me a cash dividend, this is me speaking, if you don't pay me a cash dividend, I don't know about that. So I like the way you've broken it down into dividend yield and the PE, right? Let's look at MTN, one of the darlings that people out there are buying. So MTN is going for about 292. The PE though is 13. So if I buy MTN at 292, I'm paying 13 times the earnings. but the dividend yield is way, way, way lower. 5% dividend. I know they paid dividends just in January from the guys that bought in December. So I got that dividend check. I loved it, So can we talk, what can we say around this too? If I was an investor seeking for would I just go straight to Zenith? Or would I look at, the economy, MTN is going to be the new digital in Africa, I'm going to go there. How should I also approach this as well?
So it's still around what I said. Like you also mentioned, you're a dividend guy, you like income. Over time, you want to earn income. Over time, you want to get something off your investments, So for income-loving clients or investors, would obviously advise high-yield dividend-paying stocks. So like you mentioned, mostly the banks, Zenith around 15%, around the same, so high-yield dividend-paying stocks would advise that. But if you are more comfortable in a more comfortable space and you're about growth, so the question is, okay, which companies? MTN listed, listed by introduction, we did about 90, also did a 90 for sale at 169 today is 230 thereabout. So if you're about growth, would structure would model your portfolio around the likes of MTN. But that's not to say a dividend loving investor cannot have an MTN in his portfolio if we're looking at it from a diversification perspective. So there are many angles around modeling a portfolio for the client. Even though you are more of income, if you want to make a diversified portfolio for you, we'll not just put it all in dividend yielding, because if something happens to the bank, for example, it's a policy or something, that year it might not be good. So we want to model your portfolio to be more diversified portfolio, fundamentally some companies, but maybe tilt it more to dividend yielding stocks. So MTN is a good one to have a portfolio. But like you said, yield is not so fantastic. So if you are modeling a portfolio with someone like you, you probably have a low weight in that portfolio.
Okay.
So those are some of the things we'll do that.
Okay, and then my last, do we say specific question on equities before we talk in general, just on equities. We hear commodity prices are high. We see oil prices very, very high. But I have Seplat here. Seplat has a dividend yield. This is the 2022 forward dividend yield, right? Just 3%. Why is it just 3%?
Yeah, because it also falls into the same category as MTN. They have a dividend policy which they follow, and around that dividend policy puts their yield around that 3%. But if you look at Seplat, with the growth in commodity prices this year, we saw oil price value here. We saw oil price value. The stock had actually valued more than 50%, around open year around 700. Not mistaken. Today it's around 1,300. So almost 100% return. So if you are looking at it from that perspective, there's an argument. If you really need income, you can sell some of your holdings and take some of that as profit. So take some of that as income, as opposed to just looking at the dividend. It's you might want to so because commodity prices value, oil prices are valued.
Yeah.
You see the share price so value. So same thing for price of home, agricultural stocks or stocks in agricultural trade. They are also valued in terms of share price. If you look at the price, above 50% return on both of those names. But if you look at the yield, not as low as 3%, but not as high as what you have in the banks.
Yeah.
So they value in terms of the share price, but they don't pay so much dividend. Because what you have most times is they are reinvesting, those earnings back into the business.
Excellent. Okay, great. So it's more of a capital appreciation play.
Right.
Yeah, but that's a bit, because I buy Chevron, I buy those other guys, and they are overseas. That energy stocks are more of a dividend play than a capital appreciation play. So just a bit of a difference there in terms of philosophy. So let's go to fixed income, Peter. Let's talk fixed income. I like this chart, figure 39. I'm going to share it real quick. Fixed income allocation views, where you guys have the Euro bonds, the local bonds, you have the corporate Euro bonds, you have the placements, then you have the Nigerian treasury bills. And then you guys did your views, whether we should be overweight or underweight. Now I see you guys saying you want to be overweight, which means you guys like placements and commercial paper. That's on page 30, placement and commercial paper. So why do you guys like commercial papers and bank placements? Just walk me through that.
Yeah, so again, this is investor specific. So again, who are the investors that invest in these fixed income assets? Mostly institutional investors and maybe HNIs. So you add a lot, but don't mind putting money, in the fixed income instrument, even with inflation at 8%. So commercial papers clearly, because they are more high yield, they have a higher yield in terms of returns to investors. So you can get double digits from commercial papers as opposed to treasury bills where you get 7%, 16%. Commercial papers and placements offer, higher returns in terms of yield. So that's why we favor those part of fixed income. Well, again, it's investor specific. So if you are looking to invest generally, you still have to speak to a professional.
Yeah. Okay, and then
and Carlo, if you don't mind, I'd like to chime in.
Sure, go for it.
To what Peter said. I think it's also a reflection of strategy for some, right? Because the broader expectation is that yields will continue to increase until the end of the year. So if you are playing in such an environment, the general advice is that you invest in such a way that will enable you to quickly recoup your invested funds, so that when yields rise, you can now re-enter at more favorable levels, right? At more favorable levels. So playing in instruments like placements, commercial papers, they're usually short term. So some people may just be doing that just to more or less play that strategy.
Okay.
Right? Invest short so that when you guys, they'll be nimble enough to re-enter.
Yeah, so more or less play on the short end of that yield curve, because we're not sure rates are going to go up. So don't lock your funds in for a longer period. Short. That's what I hear you say, sir.
Absolutely.
Excellent. So that's just a quick one on the federal government of Nigeria Euro bonds. I see you guys are also underweight, which means you don't really like it that much. So again, we know it's specific, but could you talk more on that? Why you think it's an underweight at the moment?
Okay, Philip, you want to take it?
Yeah, by underweight, what we mean is there's the potential impact of Eurobond price depreciation as a result of higher yields.
Yeah.
The relationship between yields and bonds, right? So as yields increases, we expect that prices will decline. So it's more to say that maybe you should time your entry into this instrument, right? There is a possibility to enter into those instruments at relatively cheaper prices when yields go up, right? So what we are saying there is time your entry, right? Maybe it will be better to enter in the next 3 weeks, in the next 1 month, in the next 2 months, when yields will be much higher, which implies that those instruments will become cheaper. But then if you are investing for the long haul, you are doing for the long haul for maybe 5, 10, 20 years, that will not be so much of a problem. So you can enter locking some, but if you are saying you are playing the next 6 months, the next 8 months, then you may be concerned about short-term expectations for rates, right? So in that sense, it makes sense. It makes sense to try to time your entry at a more favorable price. You should coincide with when yields grow. So, right? So it's so I think that may have.
I mean,
I just okay, Carl, if I can just say something about
Peter, go for it. Yeah, go ahead.
Because there's something about time. Nobody ever knows time. But the truth of the matter is, as of today, the Eurobonds have taken a beating on the back of Fed rate hike, also possible rate hike again. Now we're looking at 100 pips, rate hike. So Eurobonds are taking a beating. So for anyone who's looking to do Eurobonds, of course, you could be an HNI or something, trying to get some dollar exposure. You might want to stagger your entry because you never can tell when everything turns around. So you may want to stagger your purchases. Nobody really knows the time when everything will settle. So over time, because right now they are offering value at current levels. I think it's decent value for those who want dollar exposure. If you have dollar positions in the future or for whatever reason, you must invest in your bonds. Just to have that.
So it's more like a diversification and also dollar cost averaging. We have to diversify to build that portfolio that addresses the short, the long, the risk, and of course the not so risky per se, more or less that portfolio. That's what we're trying to build, right?
Yes, sir.
All right, guys. I mean, Peter, I could stay with you for an hour to just talk about this report. Like I said, it's a very detailed report. If you guys don't mind, I'm going to use it all month to talk about investing. I mean, there's lots of gems in this report that I could just cut, paste, and talk around. It's very rich. Guys, if you don't have this report and you want one, send me a DM or send any of the guys you see, Jerry, Philip, or Peter, a DM, or Cardinal Stone. I think their handle is right there. Cardinal Stone, just send them a DM to get this report. It's essential reading. They've done a very, very good job, if I might say so. So guys, now the floor is open. The guys that are here, I'm going to just add you guys so you guys can ask your question on investing or talk to Cardinal Stone directly and ask them a question. So it's going to be just request. I can see you, I'll add. If you don't want to speak, you send me a DM, I'll read and ask them. So I'm just going to add Issa Bashir. I have just added you guys real quick. Keep your questions short. If you can do like a minute question so they can answer you, go direct to the point, get what you want from them, you know. Let's have who is Enjoy Life. How are you, sir? Can you hear me? Hello, Enjoy Life. Can you hear me? Or should we say, let me see. First, your Twitter names, Bright Ibitoye. Give me a second, guys. Bright Ibitoye, can you unmute and go ahead and ask your question, sir? Philip, let me just, before they get ready, let me just quickly go back to this piece on the figure 38. We're talking about Ghana, Kenya, and Nigeria. So these average yields, are they the coupons or the actual yield that were on issue? Do you know? I mean, Ghana's is almost 18%. Nigeria is at 13.02%. Is this the yield, i.e., right now, the current yield to maturity right now, or is it the coupon that was issued when these bonds were issued on the Eurobond? Do you know that, Philip? Or
those were yields as a publication date.
Gotcha. Wow. 18.3% for Ghana. What's happened in Ghana? Is there going to be a contagion? Where did that come from? It didn't come from Nigeria, did it? That was a created problem in Ghana, correct?
Yeah, there were some funding related concerns in Ghana. There were needs to actually raise foreign support from the IMF. I think they've done one before. They are in talks of another. There were fears of potential defaults, right? Even though they have some other metrics that actually suggest that those threats may not actually fall through anytime soon, not as imminent as people fear, right? So you see that spread relative to benchmark very wide, suggesting that a lot of investors are likely to be more cautious. So once you have such dark clouds or concerns around the country, you find that investors will begin to price in the risk when they want to invest in the security sector of that country. So they begin to demand higher yields. So that's what happened to Ghana, right? But I think a lot is looking like they're about to change, right? With their conversations and discussions with IMF for support, etc.
I hope so. I mean, it's my personal view. They learned nothing from Nigeria. They did the same mistakes for Nigeria. I think a long time ago they sold their oil ahead of time. I.e., they did a forward sale of all their crude oil and got all the monies and tried to invest it. So I mean, their power situation. I mean, they are cutting power because they want to save money. It's a reverse of Nigeria as well. So I pray they come out of it and they come out real good. We don't need that in West Africa per se. I'm waiting for my speakers. I've got first Ibitoye, Bright Ibitoye. You can speak now. I'm going to just take you off to let others come in. And I've also got Enjoy Life. Enjoy Life, you can also unmute if you want to speak, and I can let you do that. All right, guys. So Peter, again, thanks. I have more time with you. So let me just dive into this. Peter, in terms of fixed income, right? I didn't ask you my favorite question. If I had $1 million, where should I invest it? If I had $1 million, I mean, let me tell you who I am, right? And let me just say, let me give you this scenario. I'm a 40-year-old guy. Let's say I have 2 kids. I can take risk. I would say I'm a bit aggressive, right? I can take risk, and I'm looking at managing my inflation side. So I want to get some income. I'm worried about the naira inflation. I'm really worried about naira inflation. Please, what should I invest if I have, give or take, about $1 million? How would you build me that portfolio, please?
Okay, like you mentioned, you can take risk. So, and you're worried about naira. So, I want you to give some exposure to first of all to Eurobond. So, on $1 million, like today at Capstone, we have an EIN fund that tracks Eurobond. So, I would like you to give some exposure to that. That gives you a hedge against naira. That also gives you returns in dollar terms. I mean, you get a fantastic returns if you go there. If you come into it. So first of all, 50 to 60% of the portfolio may be going there because you are concerned about naira depreciation. So we put some money there. Then the balance will now take some excessive risk with that. Excessive risk by that I mean we might put some money in the equities market. So we model your portfolio around your risk appetite. You have to gauge how that let's assume they're still pretty young, below 10. So you might not have, and because you still have a job, probably you still do. Yeah. So you might not have a need for income. So model your portfolio around 50% equities that still deliver income, and the rest of 50% around equities that maybe looked at as growth stock or opportunity stock. Because, for example, this year the rise we've seen in commodity stocks wasn't expected generally. They must started in February. So we'll be looking at doing stuff around that. So more looking at banks for income. If we're a year like this, look at agricultural news, look at the oil and gas space, like the surplus presidents for, model your portfolio around risk appetite. You still get some income, you still get some your portfolio model around getting income. You then fantastic. Then 15-14%, you are going to be very fantastic. In anywhere in the world, it's fantastic. Model your portfolio around that, and also some growth names where you get decent capital appreciation. Talk about the industrial space.
Okay.
Very inelastic demand. The company's doing very well. So model your portfolio around that.
Yeah. So more or less, I hear you say more or less for the naira guy, I should more look at the euro bonds to get me the naira income. Is that more or less where we're going?
No, for the naira, we're doing equities. We're doing more of equities. We'll keep the small 10% for liquidity, increasing liquidity. For the naira, we're doing more of equities. Okay. And for to hedge against naira depreciation, we'll do some euro bonds, probably to share our EIN fund, invest there, so that you are hedged against the naira depreciation and you get some returns in dollar terms.
Gotcha. Okay, I want to ask you about inflation, but let me see if Bright Ibitoye can speak now. If you can, Bright, go ahead and unmute. Hi, Bright. How you doing? How you doing today? Where are you calling in from?
I'm calling from
Abuja. Abuja. Your network is a bit off, so maybe speak up a bit, but it's a bit off. But let me see if I can hear you. Go ahead, sir.
Okay, that's what I'm struggling with. I don't know. No.
It's breaking, so just make it quick and I'll translate back to Philip and to Peter. Go ahead. That works for us. All right, thank you so much. Thanks so much, Philip. Okay, so Peter, what about inflation? I mean, if I was just going to do a specific investing just to beat inflation, this is like maybe a 6 to 1 year. I earn income, I can save 10% of my income, but I earn in naira. I don't want to. I mean, how can I beat this inflation that you say is going to get to 20%? Are there options for me in Nigeria or investing outside Nigeria that I can beat inflation?
Pretty tough one. Especially we're looking at 20%. In countries where these conversations are had, inflation is 2%. Well, anyway, is it possible? I think so. I think if you look at it, thinking about it now, traditional finance distorts real estate is really inflation. Why? Because you can pass on the cost to your tenant. But in this case, being realistic, what's the yield really on real estate? And of course, it has its constraints of capital. You must have like 50 million to buy flat or whatever. You probably get max 4 million rent if you are somewhere around like that doesn't translate to decent return. So that's about 8%. And if you look at gold, which is hailed as a hedge against inflation, look at today, gold is also taking a beating because the US dollar is strengthening. So gold will not work in this case. What are options to get exposure to gold? Maybe make gold ETF. But gold is also taking a beating today.
Yeah.
Because the dollar is rising, because of that relationship. So let's look at it again. We're looking at 20% now. So let's look at gaining some dollar exposure.
Yeah.
You were lucky to have $1 $5.80 to $6.20. That's about what, maybe 2-4%. Can we get double-digit euro bonds today? Maybe. That's closer to 20%, but not at 20%. The only option, I hate to repeat it, looks like equity. You mentioned Zenith Bank, dividend current dividend yield of 15%.
Yeah.
Possible capital appreciation too. If you look at our target prices across our bank, we probably have target prices in the next 1 year of up to 30-40%. Some of those names you see in the report.
Yeah.
So if you were to invest in any of those names, with those decent returns, you beat inflation. In the next 1 year.
Yeah, because you bring up that gold. Gold. I was surprised this week. Gold is negative, not just negative, way negative, right? And we hear gold is supposed to be inflation hedge. We hear digital gold. So both Bitcoin and both gold are negative. I mean, nearly double-digit negative. So that just poses to this question of where can an investor hide in 2022, 2023? Not a lot of places to hide right now. Or not a lot of places. Yeah. So someone's asking me a question for you, Peter. He said the same question I asked you. I'm a 40-year-old guy. He wants to invest. He's got 2 kids. But he said in his own case, he does not want to take risk. He's a risk-adverse guy. He just doesn't want to take any risk. That would your advice change, and how would it change?
I wish I could listen to him, because when it comes to the issue of risk, people tend to underestimate their risk appetite. You see somebody saying, "I don't want to take risk," but the person who buy a bike, dispatch bike. And you ask the person will say, "See the bike."
That is interesting.
So people underestimate their risk appetite. When you say you don't want to take risk, then normally it's lower risk, lower returns. If you don't want to take risk, you probably earn single digits. Probably just treasury bills, like that. But there's a world where you sit down with an investment professional, and a couple of questions are asked, and they make you understand your risk appetite. Because you may ask the same person and they'll tell you it's invested in bakery. They'll tell you that you don't want to take risk, but you invested in bakery. You don't take risk, but you give your sister money to do food business. That is risk. That is high level risk.
Yeah.
So people need to sit down with people just to understand the risk appetite. You think you don't want to take risk, but you are taking risk. People who claim to be risk takers will never take. Because when you understand the risk involved in the business you're doing, they might now understand that you actually have the risk appetite. So just to answer his question, let's assume he doesn't. If he has his company, it'll just fixed income asset, money market funds, or like corporate commercial papers, stuff like that. Short term. Yeah.
So more or less the same answer, but exclude equities from that. That just build out a portfolio of bonds, T-bills, CPs, and all that kind of stuff.
Yeah.
Okay.
Yeah.
Okay. All right. Let me get Akinwale in here. Hakinwalex1, how you doing, sir?
I'm good, Kalu. Good evening.
Good evening to you. How are you doing? Where are you calling from today, sir?
I'm calling from Shomolu, Lagos. That's Bagada area, sir.
Nice. Yeah. Go ahead, ask the question, sir.
Okay, I want to appreciate the two speakers so far. They've said a lot. I just want to ask a question as we are speaking concerning second half 2020 outlook, because I want to ask that with the wave of upcoming refineries coming up in Nigeria, what are the foreseen outlook towards we expect those refineries to go into operation as we are hearing before the end of the year. So what are the foreseen outlook towards the best rate, our reserve, jobs, subsidy, etc.? I hope you get my question.
Yeah, that's a great question. Philip, that's a great question for you right there. Philip and Jerry, the research guys. If Dangote refinery starts today, what will be this impact on inflation, on our current account surplus, on the exchange rate, on the government borrowing? Can you walk us through? Will there be a real change? I mean, we've seen subsidy take all the revenues. What will change if Dangote was operational today?
Well, I think it's a very useful question. And if you've been following the IMF Article 4 on Nigeria for a while, I think they've clearly pointed out, and we agree, that the launch of the Dangote refinery, or the expected launch of the refinery, is an upside risk to growth. I think the estimate is that the launch of the refinery could lead to a 20 to 30 basis points addition to whatever growth rates we are seeing now, right? But away from growth, the emergence of that refinery is also likely to lead to dollar savings. By dollar savings, I relate it to the current pressures we are facing now because we are importing almost all the refined petroleum products that we need. And it goes at least between 30 to 40% of the dollar allocation from the CBN. That's a lot. So if you take that burden out, it's more dollars for other productive sectors of the economy. It would lead to dollar savings, and the rate of reserve depletion will also reduce. In addition to that, there could be other positive externalities. There will be job creation, right? Job creation, other smaller businesses servicing the refinery or working with the refinery, and the multiplier effect. It's an upside risk, right? So we view it's more or less, it's essentially a very good upside risk to expectation, to growth, currency, reserves, etc.
So will the price of petrol, the pump price, fall?
Well, that's of course what is clear is that it will lead to increase in supply, right? So what it could correct is all the distortion that affects demand and supply dynamics, right? Distortions like hoarding because of fear of scarcity, etc. Right? So all those distortions will go. But whether or not the price of petrol will fall is dependent on how the government looks to play its policy once the refinery comes on stream. If the government decides to hands up and say, okay, you know what, we are no longer going to regulate PMS price. Of course, you expect that PMS price will adjust. And if you look at competitive markets, markets with the absence of regulation, even within West Africa, you see that PMS prices are, fair market prices are materially higher than what we have here. So you could see PMS prices trend higher. It's going to be a function of demand and supply. As it stands now, if we are to go by demand and supply, you expect that the price may be higher. So when that happens, when the refinery comes on stream, you bring whatever supply the Dangote refinery is bringing, we add to what we have currently, and you compare that to demand. It is that dynamics that will determine what prices should be at then, right? Assuming that the government chooses to stay out and not interfere with the market. But then we would have to see how it is, because supply and demand changes.
That's an interesting answer. I liked how you answer that. You basically say by economics it should change, but that it's going to be really the policy now, the decision of the government on how to implement the PIB or the PIA in this instance, that would really determine if those local pump prices will change from where they are right now. Is that what I hear you saying?
Absolutely. So policy has a big part to play.
Because Dangote is in an export processing zone, so legally he's not in Nigeria, right? And I've seen the report on Minister of Finance is going to pay for his crude oil in Naira. I've not seen any report per se of how he's going to of how we're going to pay him, if we're going to pay him in dollars or we're going to pay him in naira to import that PMS from his EPZ in Lekki. So not really clear on that. Maybe clarity will come. But I think the answer you gave in terms of, so if Dangote works today, it would reduce the forex demand from the CBN. It would then strengthen the naira because we're not demanding so much to import anymore from, say, the Netherlands to import this PMS. And that should be a bit net positive from that angle. It should reduce the pressure just a bit for us, more or less. That's what I hear, right?
Absolutely.
Okay, so I mean, the question I'll ask is this: in terms of non-crude oil imports, our imports picture getting better or worse? From your report, it shows that we are importing now more than we are exporting. So you have a current account deficit line that is just increasing. Is that only because of PMS, or has manufacturing broken down so much that the whole idea now to import my semi-finished products and assemble or just import them and retail? What's really causing that huge capital account surplus that we see on the negative side? Do you have any insight on that?
Yeah, for Nigeria, sadly, it's still a story of oil in and out.
Oh.
When I say out, I mean in terms of exports, oil still contributes to chunk,
Yeah.
right? And even in terms of imports, I did allude to that. Importation of refined product is still a critical driver of the goods balance.
Yeah.
Of the goods balance. And it's very critical for current account. But away from the goods balance, within the current account, you have what we call the services balance and you have what we call the income balance. Those balances have been in deficit for a long time, right? They've been in deficit for a long time. So although artificially we saw that the income deficit more or less narrowed because people couldn't take as much dividends, they could not repatriate dividends or profit back home because of currency crisis.
Okay.
So there was an artificial moderation in it. But what is important is that the most important component within the current account is the goods balance.
Yeah.
And I say that oil is still the critical driver.
Mm.
Yes, the government is doing everything to push non-oil export, but we're still not there yet. There are a lot of policies that need to come on stream, right, to properly enable the non-oil sector, to properly loosen the shackles from the non-oil sector to drive proper growth and export earnings.
Okay, I hear that. And guys, I've shared the report, the Cardinal Stone report on this particular space tweet, and I've also shared it on just a normal timeline. So if you want the report, go to my timeline, go to Cardinal Stone. They are one of the listeners here. Follow them and get the report. Like I said, it's very rich. So I encourage you to get it and just download or to reference it. It's got everything in there from politics to stocks to macroeconomics, as you see we're talking with Philip, Jerry, and Peter on. Philip, quick question for you. We get into this argument all the time. Is Nigeria an import-dependent country?
Well, if you say that our goods balance look at the last 5 to 10 years, the good balance tells you everything you need to know on this front. In the last 5 to 10 years, if you've let's say in the last 5 years, if for 3 of the 5 years you've been in deficit on the goods balance front, it means that you are importing more than you're exporting. Mm. So on a net basis, it means that if you have been in persistent deficits for 2 years, in excess of 2 years, I know the deficit are narrow, but it's still a deficit, right? So it means that you are importing more. So that data tells you what you need to know from that perspective. However, there were some distortions, right, that happened, right, as a result of the COVID issue. A number of sectors relapsed. They were not producing and exporting as much as they used to do. So if those distortions are resolved, and let's assume that oil prices remain kind to us, right, we could very easily slip out of the deficit. But the data suggests that we're exporting more than we're exporting at the moment.
Okay, let me push back on that, Philip, just to be devil's advocate. If we use the same scenario in terms of we have to break down that actual nominal number, the actual import nominal number, We know the average Nigerian household spends about 6-7% on food, right? Then education, power, all those guys are about 7%, 6%. If I'm a Nigerian living in Lagos, I live in Yaba, my rent is not important, right? So I'm paying a landlord. The house was built in 1970. That house is not important. My kids go to the school in Yaba. That school is not important. I buy my food. So I buy yam, I buy plantain, tomatoes, maybe rice is imported, I buy fish. Most of those things are not imported. The hospital I go to, I would say, okay, maybe some drugs, but there's Emzor drugs, there's all those Mia and Baker, all that kind of stuff is not imported. So if we were to break this down, if we strip away the nominal amount that crude oil PMX is contributing to this current account deficit, is the import itself to GDP, is it still high? So my question is, if we take that family in Yaba that lives in a Nigerian home, Nigerian school, Nigerian food, Nigerian transportation, is there imports in that family in Yaba?
Well, I think that if you strip out the impact of refined oil impact on our import, it will be a lot better. And I think when I was talking about allocations to for refined petroleum product, I think it was between 30 to 40%. It's a lot, right?
Yeah.
So assume that if that is corrected, at least the imports bill will not look as bad as it is now, right? That is corrected. But then there are other imports that we do, right? The typical household, right? They consume electricity. Let's even leave the PMS.
Yeah.
Electricity is consumed by the typical household. And if you look at the electricity pricing templates, inflation, FX rates, they are more or less, they are components within, suggesting that those who are involved in the electricity business directly or indirectly may have some sort of exposure to FX, right, in their cost elements.
Gotcha.
Right? So they are indirect exposures, right? They are indirect exposures for the companies that serves these households. So indirectly, these individuals and families are still exposed to FX, right? They are still exposed to FX. But then once you take out the burden from importation of refined products, we get a sense that importation to GDP ratio will be a lot better.
Gotcha. Okay, I mean, good point. Let me come to Peter. Peter, I'm always interested in when I look at the stock price performance. This is just the price performance. What is Wema Bank doing that they are always, i.e., their stock price is always having this high double-digit return growth? I mean, we know the big boys are there, but what is Wema Bank doing? Can we peek behind the hood, if we may? Is it because of this fintech thing? What are they doing different that the other banks are doing? Peter, if you're there, I would really like you to tell us. Yeah.
Yeah, so we don't cover Wema Bank, but I can speak to what we have in Wema Bank. Wema Bank, we did a share reconstruction. First of all, the stock that is traded around 50 covers and all that. They did a reconstruction. So the stock was now relisted at 20 cover levels. So I don't know if the chart, I don't know how the chart, we're looking at accounts for that, because what you're going to see is the trajectory pointing upward. If it's not,
I mean, it's up 343% this year. 343.
So what has led to that reconstruction?
Oh.
So probably 1 for, I'm not so sure, 148 or 84, something like that. So we listed at 300. But also, Wema is actually doing very well. I know they paid a dividend of 24 which supported, the relisted price, new share price, and they've not been doing badly. In their own space, they are very, very well in terms of interest income.
Peter, you dropped off a bit.
Pardon?
You dropped off a bit, but you're back on now. Go ahead.
Yeah, I said they paid a dividend of 24 kobo in the last financial year, which supported the share price after they released it, after they listed, after the share reconstruction.
Okay.
20 kobo. And they've not been doing badly. In their own space, they are delivering decent returns. So that is it basically. And I know they have good relationships with two of the fintechs. Because when I even try to pay through one of the fintechs, directed to Wema Bank. So that's it basically. They're not doing badly.
Yeah. is having a fintech presence, is that going to be should we say, a positive attribution to a Nigerian bank? I mean, we've seen Sprout and GT. Wema Bank is very, very strong in that space. Is this going to be what banks need to do? Is it a distraction? Does it add to earnings to be a Nigerian bank that has a relationship with fintech? Is it a fad, or does it add to fundamentals?
It definitely does add to fundamentals. We see some of the banks already doing that. We heard about the Kariba Pure banks. A lot of banks are looking at that space, But then again, the fintech, business also still need brick-and-mortar banks, who provide the platform with which they transact. So it's definitely fintech is definitely a plus for most banks. I know most banks are already looking at it. First Bank, Citibank, Access Bank and the likes. They are all looking to get into that space to be able to capture whatever market share there is available. So it's definitely a plus for the banks.
I hear you. Jerry, I don't know if you're still there. I want to talk about pensions, Nigerian pension scheme, long-term investing and mortgages, right? Because the Nigerian pension scheme, success story, we've got 13 trillion. It's invested, but we've got 13 trillion from a deficit of about 2.5 trillion. We've done that. The funds are there, all attached to individual accounts with biometrics. And I was speaking to the CEO of the Pension Operators Forum, and he was mentioning that the PENCOM, that's the regulator, and the PFAs were looking at fast-tracking this, linking the mortgages to the retirement savings account to allow some sort of, you could either pay or guarantee something will happen in that space where if you have an RSA and then you have a mortgage, that could sort of let's bring a convergence. Will that be a big impact to the Nigerian economy if that 13 trillion is taken away from bonds where it has currently to go more into mortgage-backed securities like REITs or just traditional mortgage-backed? What would change? Is that going to be a net positive? Is that going to be a major disruption? Should we do it? What's your take, Jerry?
Well, that's interesting. I know this conversation has been going on for a while to see how pension funds will be directed towards supporting infrastructure deficits, right? But then, these are people's money, right? And it's still highly regulated, which means that if we have to do a lot of mortgages, right, there's a liquidity concern. What happens to those who are retired, right? So in as much as that is likely to happen, it's still going to be within the framework of very tight regulation, which means that only a percentage of pension funds are allocated to that kind of program. It's also that we are seeing at the moment, right? So you have your retirement account, your PFA account, and depending on the fund you are in, right, there's allowable limits or there's a range, there are constraints. I think that's the word, there are constraints for how these pension funds can deploy people's retirement accounts. So yes, that would be positive considering what we need to do on the infrastructure side.
Yeah.
But then again, there is still the angle of those funds will have to match assets and liability.
Yeah.
Within the 10 years. So that's a constraint, the extent to which when
because Jerry, it's the way it's structured. It's my money, right? So I open up the account. It's in my name. I get the account in my personal name. It's not in the name of my employer. And I'm living in a house in Yaba. And the landlord says, I can sell this house to you, right? Maybe rent to own, or you have to pay me a down, or I can go to the bank and have to pay a 20% down payment. I'm still wondering why I can't go to my PFA and say, hey, I have 10 million naira with you guys. I want you guys to give me 2 million. And I can only take that money. The PFA can write that check to the banker or the landlord. It can only go to mortgage. And I buy that house, pay my 20% down, and I'm now own the house and I'm paying rent to own on that property, right? For the next 20 years, because I'm a very, very young guy. I'm a Nigerian, so I'm a younger person. I have a long time to retire. And then the PFA just collates all those mortgages packages the mortgage-backed security, and sells to Cardinal Stone for you guys to invest. It ticks all the boxes. Philip, don't you agree? It ticks all the boxes. Long-term investing, mortgage investing, giving wealth and equity to individual Nigerians, making them wealthier, and really using that pension contributions into something Nigerians can hold and say that this thing actually works. What do you guys think?
So one way to look at it also depends on the contribution plan. So if it's a defined, what you just described, if it's a defined
contributory
plan, where the employee or the person concerned can determine, how the assets can be allocated, then that's can really easily work after a lock-in period or something, right? Depending on what the policy is. But for defined benefit, which is what most employees have at the moment, there's likely to tight constraints on that. But for defined contributions, where you get to contribute to the tax states and you can determine how it should be allocated.
Yeah,
I think that's.
I agree. I completely agree. So, guys, let me just ask you a question, Philip. Philip, what's the good news in Nigeria right now? If you had to hook onto good news, either now or in the next 3 to 6 months, what would you say I should focus on? That if this becomes positive, then everything translates into a positive return. What good news or what data point should I sink my claws into and just ride? What would you say, Philip?
Well, in terms of positive data, I think the most handy one is GDP growth.
GDP growth,
right? GDP growth. We have a couple of big economies that contracted in Q1. Big economies, US and a few other big ones, but Nigeria managed to grow. So that suggests that we are mostly insulated from the geopolitical tensions and roars across the globe.
Yeah.
Right. So that's some positive to hold on to, right? And you did allude to its comparison with population growth, just at 3%, right?
Yeah.
We're not there yet, but then it's a positive indicator, right? We have so many other ones that are not bad. We hold on to it, right? See how far we can do policy and private initiatives actually sustain the momentum and cascade the positives to other variables as well.
Philip, put yourself that you are talking to either Bola Tinubu, Atiku Abubakar, or Peter Obi. What would you tell them that would double GDP growth in 12 months? Take it from 3 to 6. Get 2 policies that you think will double GDP growth, straight up, from 3% to 6%. What do you think?
I think policies that would provide enabling environment for capital. Now, there was this exercise I did where I looked at gross capital formation and I compared it with FDI inflow as well as oil prices.
Yes,
I discovered that those areas where we had significantly better FDI than FDI inflows into the economy corresponded with robust GDP growth. Look at the pre-2016, right? Pre-2016, we're seeing 6%, 7%. Then you had a lot of capital formation. It was way higher than what government was pumping into the economy. Capital formation was coming from FDIs, So if I were to speak to them, I would say go more pro markets or provide an indication, a clear indication that you have a plan to go pro markets over the next, say, 1 to 3 years.
Yeah.
And that would more or less increase the credibility of the government and foreign capital to begin to go. Because it is clear that the government on its own, look at tax revenues to GDP, it's nothing. Right? CBN, we've established here that CBN cannot single-handedly continue to defend the currency given where the reserves are at. Right? So you need foreign injection. Right? You need foreign injection of capital. We think you also need to enable the non-oil sector as well. So for policies, look at the currency policies. It is not healthy that foreign investors will bring money into the market and will be struggling after 2-3 years to take their profits back.
Mm.
There are a lot of foreign investors in Nigeria that have funds in Nigeria today or dividends in Nigeria that have been trapped since COVID or even before COVID. That's on 2-3 years of dividends stock in Nigeria. And you expect those individuals to still bring funds into the fund. So it doesn't work that way. So I would say they should address the encumbrances in the FX market, the illiquidity issues. They should look at trying to maybe provide more subsidies in key. I mean not subsidies now. I mean like incentives in key sectors, especially sectors that are labor intensive, not labor intensive, sectors that more or less have the capacity to absorb a lot of labor force.
Yeah.
Right. So incentives should be directed at those sectors. That would support inclusive growth. So when we're talking about growth, we know that those sectors are receiving extra support, right, to push growth or more or less to enable growth in those sectors, which will make our growth reasonably more diversified and more inclusive. And you must also add those pro-market initiatives. Look at the currency market, try to make it friendly, at least good enough for investors who want to even consider it. The same applies to electricity.
Yeah.
There are a lot of investors complaining in the electricity market sector. So look at those value chains and try to more or less make sure that at least the returns they get is good enough to compensate for the cost being incurred.
I hear you, and I have that. I think it's figure 26 that on your report. That's on page 20, where you talked about the foreign direct investment flows and the foreign portfolio investment flows to Nigeria, and of course you had the net financial accounts going up and down. FDIs in Nigeria has crashed. Foreign direct investment, which is more longer term, right? That has crashed. And the FPIs, I think, are coming in here to chase the very, very high yields that the Nigerian DMO is offering. So are you essentially saying we should try, though this policies will try to maybe address more of the FDI side, and of course, if we unblock the remittances going out of Nigeria, we can fix the FPI side, so that way we can get remittances into Nigeria. Is that what I hear you saying, Philip?
Absolutely, yeah. And it's important that you mentioned FDI, long-term capital, so important, right? Yeah. We just capital flow, right? Capital inflow. FDI is important.
Yeah.
Then other things like trade credits, grants if you can, right? To enable the growth. Then also try to also enable more exportable products, the production of exportable products, because they also earn you decent foreign currencies that will also support growth.
Great. All right, guys.
Policies are important.
Excellent. We've been here for about 2 hours. I've been speaking to the folks from Cardinal Stone, registered stockbroker, asset manager, about their new report that they have out. It's titled, let me see, Same Challenges, New Shocks, Nigeria 2022 Mid-Year Outlook. I think it's perfect. If you want to get a copy online, on Twitter on my handle or their handle as well there. We've got Jerry, Philip, and Peter. Springs also give or take about 2 hours. We're going to start to round this down. They've been here for a long while. I want to just appreciate them for hanging in here. So let's take a last guy. I think DJ is here, wants to say a word. We'll take DJ in and then we'll just have to wind down the room and just thank everyone. DJ, hi. Go ahead.
Hi, Carl. So I saw the request. I don't know if I should make a comment or a question. I have a question. Should I start with that?
Yeah, go for it.
So, subsidy and listed companies that are impacted by this problem around subsidy, like Total, they've not been a good investment play because of the issue around subsidy and because of the government's control around that environment. I'm trying to rephrase it should we anticipate an opportunity in that industry in the short term? Do you think subsidy will go? Should I put Total on my watch list? Or what are you thinking with respect to this government, with respect to opportunity to invest in companies like Total and Co, or maybe even the next government?
That's a good question. I think it's almost tied to that Dangote question we asked earlier, Philip and Jerry. That Dangote question. It's more or less, what if PIA, the PIB, the PIA, the Petroleum Industry Act is implemented, is that positive for the petroleum marketing companies, the downstream guys selling PMS on the street? Will that make them have more revenues? I think that's my own addition to DJ's question.
All right. I think the aspect of the PIB that relates more to downstream is that suggested that there may be a better or greater tilt to demand and supply driven prices in the downstream. So if that happens, we think it's going to unlock significant value. I think we did an exercise when we compared markets that are where prices are deregulated, African markets where prices are deregulated versus Nigeria. And what we found out was that if we are to experience a deregulation in Nigeria, prices are allowed to be determined by demand and supply, margins of the downstream players could improve by at least 200 basis points, right, from current levels, 200 to 300 basis points. And that's some decent push, right? That would more or less put them out some other downstream players across Africa. So deregulation is always seen as the upside risk for downstream players. We believe it's going to unlock a lot of value if it happens, right? And I guess a lot of downstream companies also are looking forward to it, and even investors that have been there patiently waiting, maybe very long-term investors, hoping that one day the sector will be fully deregulated and the shackles will go off and margins will improve considerably for the betterment of our investors as well.
Interesting. DJ, does that answer your question?
Just to add to that, Carlos,
yeah, go for it.
You mentioned something about the performance of Total over time. Yeah. I think if you check last year, Total was one of the best performing stocks because it made over 70%. Probably opened the year at 132, closed above 200. So they've been doing well in the downstream space. But like Philip highlighted, he has highlighted, when the subsidies eventually improved, more spread, because they can now import directly PMS and to be a market player who brings in PMS cheaper, who's able to sell distribution network and all that. So in the last 1 year, they've had a good one. Downstream sector, even this year, if you look at the Q1 numbers, it's still a good one. So Total definitely is one for you to keep on your portfolio and keep watching.
So Peter, let me take you up on that. So last year that result was good, and you're right. But we were coming from price-wise a low base in the price of what's it called now, crude oil price. So which means that subsidy in the early part of last year wasn't really a lot, and that allowed for maybe market players to really have a little bit of leverage. But as we moved on into the year and into this year, it's a subsidy play. At peak. And to be honest, I actually sold Total from my portfolio because I just felt that it's now a government business. It's no more in the hand of the student player. Help me understand if I did right or wrong.
So Total is a French company. It's not a government business, it's a private business. So what you must understand about subsidy, first of all, NNPC is so important, of PMS. So what the play really is for the downstream players is about distribution network. It's about managing your costs. What happens to them when they fell, the year before when the stock price was done? The finance costs were able to manage their finance costs well. But if you look at the numbers for last year, you see that it's better in terms of their net finance costs. So what the play is really for the downstream guys is distribution network, is managing your finance costs. You have an edge, it's just PMS. Or you have lubricants like the right of Total. They can increase prices in lubricants, get decent spread there. So that is the edge in that business. But it's a private business, not a government business. So, not necessarily a bad move you sold, but watch it, it's something to watch. It's something to watch. Look at the Q1 numbers, you see that the numbers are still very fantastic. These prices are busy now, become shock of the prison now. I don't know what Q2 look like. But if you look at it, they're doing very well.
Okay, so I didn't mean that it was Total is a government stop. I mean that the government is responsible for 100% importation. That was what I meant. But thank you, I got the message. Thank you, God.
Hey, great job, DJ. So, guys, let's sort of wind it down. Thanks. I don't want to keep you guys past your bedtime, right? So let's have Jerry, Philip, and Peter just give us your closing thoughts, and we'll take it from there. Thanks, guys. Let's start with Jerry.
Yeah, okay. So I think it's been good. We've been able to share most of our views. I know something I wanted to add when Peter was talking about the issue of fintech and banks, right? And what I think is the vibe that we get from most people is that banks are threatened, by fintech players. So that's mostly the motivation for banks are doing, which, frankly, is not the case. Right? Banks have been doing well. What you see mostly is a lot of collaboration with fintech. The market space there is huge, incredibly huge, for everyone to take a pie. And besides, look at since we had the accession of fintechs, you look at 2017, 2018, between then and now, banks have constantly grown in all of the metrics you can look at. If you're looking at retail deposits, they've outperformed the levels they were at. Or if you look at retail lending, they've outperformed that. Transactions, transfers, NIP transfers, banks control as much as 90% of the markets. So every other, whether it's Momo, PSB, they all share the remaining 10%. So banks going into, trying to diversify into fintech is just more of trying to position themselves for disruption. And when I say disruption, I mean the change in how business is being done, right? Not necessarily that they're going to deny, it's just, the change, the change in the dynamics of doing business, to be able to cope with current realities, to prove their agility. And I think that's just what it is. So good for the banks, very, very large markets for anybody to play in. And we'll see where it takes us.
So essentially the disruption argument is oversold. Is that what you're saying?
I think it's down to how people define disruption, right? It's down to how people define disruption. So if disruption means that banks are going to lose all their customers, if it means that banks will no longer get fee and commission income from electronic products, then I think that's really oversold.
Gotcha.
When it is down to how we do business, how we do banking, I think banks have been investing a whole lot to maintain agility, to improve their resilience in this space.
Gotcha. All right. Let me get Philip. Peter.
Okay. I think we've had a good conversation. Not much to add. For me, I think what I would advise, because what I see, the narrative out there is mostly jacked by what is running. The question is that bad? Is that bad? In Nigeria, the answer is yes. And I think from what we've seen happen, the last 7 to 8 years have been very tough. But I want to believe we're coming out of the lows. I don't think it can be worse than this. I want to encourage everyone out there coming out of the lows, and everybody should be right in position to take advantage of what we'll be going into next year. I think better days ahead. People should be ahead of. Build a portfolio, and don't underestimate what you can achieve in the long run. Everybody's about fast money now. Everybody jumps in crypto. People are doing betting and all that. Traditional assets are still doing very well, and there's value in building a portfolio. And if you want to do this, talk to us. We're readily available to take care of.
Can you share? How can I get across to you, Peter? If I want to.
Cardinal Stone. Cardinal Stone. Yeah, Cardinal Stone. Cardinal Stone is on this call.
Yeah.
I'll send it to you. Cardinal Stone.
That's it.
Yeah.
So I lost Philip. Philip, I think Philip can still speak. I see his request, but I think he can still speak. He's still yeah. So I mean, if you want, like Peter said, if you want to get in touch with Cardinal Stone, send them a DM. Their handle is right here on the tweet feed. You can just send them a DM. Peter, I'm not sure why I can't add you. I think because you're a co-host. So if I cancel the co-host request, can I add you as a speaker? Yes, I can. So now you're just going to come back in as a speaker. So I mean, it's been a great session with Cardinal Stone. Learned a lot. I've got access to the report. The report is shared. You guys can grab it and run with it. Lots of good information there. Lots of political information there as well. The economic side of the politics argument, though, not the voting side. Macroeconomic stocks, equities, the world, and all that. So grab onto it. do read it and do make yourself a better investor. The more informed you are, I think the better you are. Here we only talk about money, finance, and of course the economy and how it impacts you on a personal level. So that's why we always like to bring guests like this to you guys so you guys can learn and make yourself better. So I'm going to shut it down, guys. I do appreciate you guys all tuning in. Do get my book, Let's Talk About Your Money, where I try to make money really, really easy for you. About 229 pages, about 22 chapters of just investing, budgeting, crypto, planning to invest during inflation, really estate planning, anything you can think about in world of investing. I'll pick those topics to basically aid you to read it up and make yourself better. It's available on Robin Heights and also available on Amazon. All right, guys, I do appreciate the time you guys have spent with me today. I don't take it for granted. I'll see you guys next week. We'll try to bring a guest for you as well. So do take care. You guys be good. Take care of each other. I will shut down the space now in about 5, 4, 3, 2,